Hey, did you notice that in our last deep dive on DEI, the intro music actually played twice?
I did. I thought my computer was glitching. I was looking around thinking, did I double-click something?
I listened to the whole thing twice. I thought maybe our producer was testing us, to see if we were paying attention.
Oh, we're live now. Good morning, good afternoon, or good evening, wherever you are in the world, and welcome back to Sip&Talk.
Welcome, welcome. We are so glad to have you back for Sip&Talk. I'm Joe. Today, we're going to be rapidly assessing all the latest global financial signals, tracking shifts in global sentiment.
Analyzing those tech flows.
Exactly. And most importantly, turning all those incredibly complex market signals into, some actionable thinking points for you.
That's right. Our whole guiding principle here is pretty simple. The information has to be current. It needs to be cross-referenced, and it has to let you understand the logic behind the trends, not just, overwhelm you with a bunch of raw numbers.
And let's be honest, the recent market correction has been a little unnerving.
Unnerving is a good word for it, yeah. A bit later in the show, we're actually going to share a fascinating segment where we dissect Mickey's latest investment strategy adjustments.
Oh, this is good stuff.
It is. His approach has shifted, just subtly, but it provides a really interesting reflection of how the overall market mood is changing under all this pressure.
Yeah, his whole style leans into what you could call an economic cycle adjustment. When the market's high, he loves the broad index. But when we hit these deep corrections, he pivots really aggressively towards specific high-growth sectors.
So we'll discuss how he's viewing the market right now, which sectors he's prioritizing, and how he's reconfiguring his own capital. It's like a real-world masterclass in applying macro thinking to individual stocks.
It really is.
So this entire discussion is really tailored for you, whether you're watching those 2026 trends or just actively debating if you should adjust your portfolio right now. Just remember, we are not professional investment advisors.
Not at all.
This is all for reference and entertainment. We're just impartially reporting on the facts as we see them.
With that out of the way, let's jump straight into the challenge that's facing every investor right now. Today's big question is, buying a big red candle, brave move or bad idea? Okay, so let's unpack this. Before we can even decide whether to buy that big, scary red candle, we need to know what exactly sparked this widespread global sell-off in the first place.
Right.
It feels like Wall Street's warning bells are ringing. And the fear isn't just about a normal dip. There's a real worry about a full-blown correction.
Well, the core driver is absolutely clear. Investors are just pulling back from higher risk assets everywhere, globally. We can see this in things like the MSCI Asia Pacific Index dropping to a one-month low.
Okay.
The anxiety really boils down to two big factors. First, valuations in tech, especially the big names, they're undeniably high. And second, and this is the crucial part, there is just massive, painful confusion over the Federal Reserve's timing.
The Fed confusion. That uncertainty seems to be doing more damage than any single piece of bad data.
Precisely. I mean, just a few weeks ago, the market had aggressively priced in a December rate cut. The probability was hovering around 70%.
Right. It felt like a sure thing.
It did. And now that probability has completely collapsed to around 40%. That massive swing tells you there's a significant, very visible internal division within the Fed itself about where to go from here.
And then right in the middle of all that fog, you had Federal Reserve Governor Christopher Waller come out and publicly support a rate cut.
He did. He framed it as necessary risk management, especially with some labor market reports suggesting, underlying weakness.
Okay, here's where it gets really interesting for me. If a Fed governor is literally saying we should cut, why is the market still so confused?
It's because the data is, for lack of a better word, bifurcated. It's split right down the middle.
What does that mean in practice?
It means we're seeing completely conflicting signals from key employment reports. The ADP data might suggest one thing, then initial jobless claims point another way, and the government's big monthly jobs report might tell a third, totally contradictory story.
So there's no clear picture?
None. And this inconsistency makes the Fed's job impossible. Their lack of a strong, unified consensus just fails to inject any desperately needed confidence back into the market.
And you can actually see this playing out in the bond market.
Oh, absolutely. Look at the 2-year Treasury yield. Normally, that yield tracks the market's Fed rate expectations almost perfectly.
Okay.
But recently, they've started to separate. That divergence is a big technical red flag. It tells us that the bond traders, the people who are paid to worry about risk, are starting to bet that the Fed might have to hold rates higher for longer than the stock market wants to believe.
So they're preparing for a bumpy ride.
They are. They're moving based on structural risk, not just the daily noise.
Okay, so the macro picture is scary. But if you just look at the headline number, the S&P 500 is only, 3% below its record high from October? That doesn't sound like a catastrophe.
That is the deceptive part. It's the headline veneer. While the index itself might look resilient, the technical damage happening underneath the surface it's substantial. You have to look at the internals.
It's the health of the average stock.
Exactly. And what do the internals tell us?
So what are they telling us?
They're telling us the selling is broad, it's pervasive. Roughly half of all the companies in the S&P 500 are now trading below their 200-day moving average.
And for anyone who doesn't track technicals, the 200-day is a huge deal, right? It's that line in the sand.
It's a critical line. It's the long-term trend. So when so many stocks break below it, it confirms the selling pressure is distributed widely. It's not just a few weak names anymore. It's a sign of real systemic technical weakness.
So even if the biggest names, the Apples, the Microsofts, the NVIDIAs, are holding the index up,
the foundation is crumbling, even if the roof looks okay. And that is what creates the perfect stage for a big red candle event.
This selling pressure, it just inevitably brings us to the elephant in the data center, AI. The market is so anxious about tech valuations, especially with huge earnings reports like NVIDIA's coming up. So let's just have the debate. Is this a healthy bull market, or are we just repeating the dot-com bubble?
It really is the classic standoff, the bears versus the bulls. And we have to start with the bear camp because their warnings are just thunderous right now. Take Jeffrey Gundlach, the founder of Double Line Capital.
The bond king?
That's him. He argues that if you measure the market's health using classic metrics like the Shiller PE ratio, it is the least healthy he has seen in his entire career.
Wow. And the Shiller PE, just to remind everyone, that smooths out earnings over 10 years to get a better picture. So if that's at an extreme?
He says valuations are, and I quote, off the charts. Historically, the average Shiller PE is around 17 or 18. Today, we are flirting with levels we've only seen at the peak of the 1929 bubble and the 2000 dot-com bubble.
So his conclusion is pretty stark.
It is. Valuations are disconnected from reality. And his advice for you right now, hold a significantly larger amount of cash.
That is a clear warning of a massive correction. But then you have the bull side, right? People like Nancy Tanglin from Lafayette Tanglin Investments. She's arguing the complete opposite. She thinks valuations are healthy. How?
Well, her argument really hinges on two things, growth and policy support. She points out that the major growth companies, the big AI players, are averaging about 20% earnings growth, which is really robust.
Okay, 20% is solid.
But more critically, she's forecasting accelerated earnings growth next year. And she argues this isn't just speculation, it's being driven by structural policy.
You mentioned the Bill Act. What specific mechanism is she talking about that boosts earnings?
She's referring to parts of recent legislation that specifically accelerate the depreciation of capital expenditure, or CapEx. So when companies can write down the cost of massive investments faster, like building new data centers, it lowers their immediate taxable income.
So it's a tax-driven boost to their reported earnings.
Exactly. And it makes those high PE ratios look more reasonable when you measure them against these policy-enhanced earnings forecasts.
So she's saying the high prices are justified because future earnings are backed by real investment and, some temporary tax help. But what about the poster child of all of this? NVIDIA. I mean, we've seen Peter Thiel's fund selling, Michael Burry shorting it. How does she defend that valuation?
Her defense is really analytical. She moves past the current PE ratio and looks to the future. She calculates that even at its current high price, if you project NVIDIA's earnings out to its fiscal year 2027.
So 3 years from now.
Right. And you assume 50% year-over-year growth, the stock is trading at only about 26 times those projected earnings.
26 times forward earnings. I mean, that is still a huge projection. It requires flawless execution.
It absolutely is, and that's the risk. But the bulls argue the execution is essential because the demand is, it's non-negotiable. Tanglin sees this AI infrastructure boom lasting well into 2030, with the total market size hitting a staggering $3 to $5 trillion.
That kind of scale is just mind-boggling. And when you hear trillions, the skeptics naturally start screaming, AI bubble 2.0. What's the concrete evidence analysts are using to say, no, this time is different?
Joanna Shen from JP Morgan Asset Management had a really clear breakdown. She pointed to two vital structural differences between today in the year 2000.
Okay, what are they?
The first one is the source of the funding. Back in the dot-com boom, you had thousands of unprofitable companies running on high-risk venture capital and junk debt. The market sneezed and they died. Today, the massive capital expenditures are mostly self-funded by the hyperscalers, Amazon, Google, Meta, Microsoft. These companies have fortress-like balance sheets and tens of billions in free cash flow. They're building the AI infrastructure with their own profits.
That is a fundamental difference. So the foundation is solid financial bedrock, not just promises and debt.
Exactly. And the second distinction is actual immediate demand. Shen points out that current data center utilization is near saturation. Companies are desperate for more compute power right now.
As opposed to 2000.
In 2000, the frenzy was about laying fiber optic cable. When that bubble burst, the utilization rate for all that new fiber was only about 7%. All this infrastructure was just sitting there, dark and unused.
So the lesson is, building a highway is only a good idea if there's already a traffic jam on the old one.
That is the perfect analogy. And since this is a global race, you see really different investment philosophies. The US model, OpenAI, it's closed source, a winner-take-all race to AGI. It means massive spending for potentially massive but very high-risk returns.
It's the classic Silicon Valley playbook. Huge bets, huge rewards, but also a huge potential for failure.
And you can contrast that with the Chinese strategy, especially from giants like Alibaba and Tencent. They tend to favor an open source, more collaborative model. They're financially more cautious, often using government subsidies.
Does that caution make it easier for them to actually make money from this?
Well, both models face big commercialization hurdles. The US has this staggering infrastructure investment, but actually getting companies to pay high-margin subscriptions for LLM software is proving slow. It's hard to find the true killer app.
And for China.
Their open source model reduces reliance on expensive cloud services, which is good, but it also makes it harder for the platforms themselves to monetize in the short term.
So it sounds like everyone's waiting for the next big thing. What are experts predicting that will be?
The consensus really points to a shift from the data center to the individual user. The edge computing revolution. Think AI assistant glasses, wristbands.
Things you wear.
Exactly. The design philosophy is always on, always listening, always thinking. This moves AI from a service you access to a technology that's just embedded in your daily life. And that promises the next huge wave of consumer sales and infrastructure demand.
Okay, so while we wait for those AI glasses to arrive, the big red candle we're seeing right now, it reflects stress points in the real physical economy. We need to look beyond tech to the world of, buying things and shipping things. Let's start with the consumer. We're seeing some real cracks in discretionary spending.
Yeah, the big alarm bell here was the revised earnings guidance from Home Depot. It caused their stock to have its worst trading day since early 2023.
And that cut was blamed specifically on people pausing big-ticket purchases, right?
That's right. Things like a full kitchen remodel or replacing all your flooring. These are the kinds of expenses you can comfortably put off when your confidence about the next 6 to 12 months starts to fade. Home Depot is a perfect barometer for that.
But the picture isn't all bad. I saw some interesting contradictions in grocery retail.
It's fascinating. Stu Leonard Jr., the CEO of the grocery chain, noted that while people are pulling back from restaurants, they're trading up in their grocery carts. Sales of prime rib and premium ice cream are up.
That's the psychological offset.
Yeah.
I can't afford the fancy restaurant, but I can justify buying the expensive steak and eating it at home. It feels like a splurge without the massive bill.
Exactly. And even more curiously, high-priced convenience foods, like chef-made mashed potatoes, are also selling well. So people will still pay a premium for convenience. But he also said the single biggest issue for his suppliers, the farmers, is still labor costs.
Okay, so moving from the grocery store to the highway, what's happening in the freight market? If the consumer is sputtering, logistics must be feeling it.
The freight market is facing a really significant inflection point, and it's predicted to hit hardest in 2026. The CEO of RXO, a logistics company, projects a meaningful shift. But it's not being driven by a collapse in demand, it's being driven by capacity exit.
Capacity exit. So trucks are leaving the road. Why would they be leaving if demand is only down a little?
It's a structural supply problem. Estimates suggest upwards of 10% of trucking capacity is exiting the market. This is partly due to new regulations, new restrictions on drivers, and stricter language requirements. It's just getting harder and more expensive to operate.
Okay, so what's the key data point that shows this?
Well, the cash rate index shows demand is down about 7% year over year. Now, normally when demand drops, carriers get desperate for loads. So tender rejections, the rate at which they turn down a load, should fall.
But they're not.
Instead, they're rising.
Wait, rejections are rising even though there's less stuff to ship? That is a classic signal of a structural crunch.
It means the remaining trucks are refusing loads because the rates don't cover their rising costs. I mean, truckers' operating costs are up 34% since 2014, while rates have been basically flat. It's forcing small operators out of business.
But when demand eventually comes back, we're looking at a huge price surge.
That's the prediction. And it's why companies like RXO are turning heavily to AI. They're using what are called agentic AI bots.
Okay, that sounds like a buzzword. What does it actually mean?
It's a step beyond simple automation. An agentic bot is an autonomous program you give a goal to, and it can break that goal down into tasks and execute them without constant human intervention.
Like a self-managing digital employee.
That's a great way to put it. RXO is using them for back office work, for real-time pricing, and even to check compliance on last-mile deliveries by analyzing photos. They expect AI to boost their margins by 1 to 2 percentage points. In logistics, that's huge.
So let's look at the broader supply chain. This all ties into tariffs and geopolitics. What are leaders saying about resilience?
Well, CEOs like Damon John of FEBU are unanimous. The only consistency you can rely on is inconsistency. A lot of companies learned lessons during a pandemic about needing a plan B, C, and D, but then they lost focus once things calmed down.
People have short memories.
They do. The key defense against all this is just relentless diversity in your supply chain. You can't rely on a single source or region anymore.
Yeah.
And this is where we have to note the external pressures. For example, the recent diplomatic friction between Japan and China over comments about Taiwan. Now, we don't take any political side, but we have to report the economic risk. One such risk is that Beijing could respond by limiting exports of key minerals to Japan, things like graphite or rare earths.
Which would be catastrophic for Japanese high-tech manufacturing. It's a perfect example of how global politics creates immediate supply chain vulnerability.
It does. And on trade, tariffs are still a moving target. The big concern is that the consumer just can't absorb all the initial costs, so retailers often have to split the costs with their suppliers, which just squeezes everyone's margins.
Okay, last check-in on the real economy. Corporate credit. Is all this volatility in stocks spilling over into the bond market?
It is, absolutely. Risk premiums on both investment-grade and junk bonds are near multi-week highs. That nervous risk-off behavior is definitely moving from equities into credit.
So investors are finally demanding to be paid for taking on risk.
They are. A great example was Amazon's recent $15 billion note sale. The initial interest from investors was phenomenal, over $80 billion.
Wow.
But once the bonds were actually priced and investors saw the real interest rate they'd get, that interest dropped off a cliff down to $47 billion.
That is a huge drop in demand right at the moment of truth.
It confirms that investors are becoming much more discerning. They're not blindly chasing yield anymore. They're doing their homework and actively looking at risk, even in the normally stable fixed income market.
Okay, so we've established the chaos. Fed confusion, AI anxiety, stress in the real economy. Now let's tackle the big question. Buying a big red candle. Brave move or bad idea? But before we do, let's just define our terms. What's the difference between a normal shakeout and a total disaster?
This is so foundational. When your portfolio turns red, you have to know which or two things is happening. First, there's a correction. That's a drop of 10 to 20% from recent highs. Corrections are common, they're healthy, and they clear out speculation.
They bring things back to earth.
Exactly. Then second, you have a bubble burst. That's a drop of over 20%, often followed by a long, painful period of low performance like after the year 2000. Right now, the AI situation, because of the strong corporate balance sheets we talked about, it leans much more toward a correction than a catastrophic bubble burst.
Okay, so we're likely in a correction scenario. Now, specifically, what is this big red candle we're talking about, and why is buying it such a high-stakes move?
So the big red candle is a technical signal. It just signifies a day of intense, massive selling pressure where the closing price is way lower than the opening price. It's a day of panic.
Capitulation.
Capitulation, exactly. When you buy that signal, you are using a counter-trend trading strategy. You're betting the market overreacted and a sharp rebound is coming.
That sounds inherently risky. You're literally fighting the immediate trend.
It is the definition of high risk, high reward. And the outcome, whether it's a brave move or a bad idea, depends entirely on three critical factors: position, confirmation, and risk management.
Okay, let's break down that first one. Position. You're saying where the candle appears changes what it means.
Fundamentally, if that big red candle appears at the top of a long, strong uptrend, it's usually a bearish reversal signal. Buyers are exhausted. Buying it there is a bad idea. You're probably catching a falling knife.
Okay, so that's the bad version. What's the good version?
The good version is if it appears after a long, sustained decline, it might represent climactic selling. That's the moment when everyone who is going to panic finally throws in the towel.
That's the moment of peak pain we always hear about.
Yes. And that extreme negative sentiment, especially if it happens at a key long-term support level, is often the prelude to a bullish reversal. In that context, buying it could be a very brave move. Context is everything.
Okay, so that leads to the second factor, confirmation. Even if I wait for peak pain, I can't just jump in the second I see red, can I?
Absolutely not. And this is where most emotional traders fail. You never buy the candle itself. You have to wait for confirmation that the selling pressure has truly been absorbed.
And what does that confirmation look like?
The gold standard is a strong green candle the very next day. A bullish signal that shows buyers stepped in and completely dominated the session, absorbing all of that panic from the day before.
Is there a name for that pattern?
Yes, it often forms a technical pattern called a bullish engulfing pattern, where the green body of the new candle completely swallows the prior red candle. That tells you the market has processed the panic. Buying before that is just gambling.
This requires incredible discipline, especially when your gut is screaming at you to either buy or sell.
It does, and that brings us to the third non-negotiable factor: risk management. With a high-risk strategy like this, you have to control your downside. Before you even place the trade, you must set a clear stop loss.
And where would you typically set that?
For this specific strategy, the stop loss is almost always set just below the absolute low point of that big red candle. If the price breaks that low, your whole thesis was wrong, and you get out immediately. You control the loss.
So bringing this all back to the average person watching their portfolio bleed red, what is the single most important psychological takeaway from all this?
The biggest mistake you can make is panic selling. You have to step back from the daily noise and look at your long-term thesis. If the fundamental reason you own a company hasn't changed, then a correction is an opportunity to buy a quality asset cheaper. It's not a signal to abandon ship.
So what are some practical steps to maintain that discipline?
Diversification is key across sectors, across geography. Control your leverage so you don't get a margin call at the bottom. And critically, you need to practice rebalancing.
Rebalancing, the definition of doing what feels wrong. You have to sell your winners to buy your losers.
It's totally anti-human behavior, but it's crucial. If your target is 60% stocks and 40% bonds and stocks fall, your allocation gets out of whack. To rebalance, you are forced to sell some of your stable bonds to buy the beaten-down stocks. It systematically forces you to buy low and sell high over the long term.
Okay, speaking of discipline and anti-human strategies, let's look at how our friend Mickey actually puts this into practice. It's one thing to talk theory, but
it's another to see it operationalized. Yeah. And it's fascinating because his doomsday stocks, as he calls them, have actually been remarkably anti-fragile lately. They're resisting the sell-off.
Maybe they were already so cheap they just had nowhere left to fall.
That's often exactly what it is. It's a reflection of market psychology. But his strategy, which we're presenting just as a model for discussion, provides this highly structured framework for buying the red candle.
It's very calculated, almost robotic.
Yeah.
So let's walk through his framework. And again, this is his personal model, not advice for you.
Right. So his core idea is to redeploy cash into high-conviction individual stocks. But he doesn't rush. His first step is the waiting game. He waits rigorously for a specific gap. The price difference between the decline of the broad index and his chosen AI essential demand stocks has to hit a massive 12 to 18%.
12 to 18%. That is a huge gap. He's literally waiting for the market to create maximum divergence, where the index looks bad, but his specific stocks look catastrophic relative to everything else.
Exactly. He's hunting for extreme relative pain. Once that signal hits, he executes the initial brave move, and this is key. He only does it on the day after the massive index sell-off.
So he buys after the big red candle, not during it. He waits for that confirmation.
Correct. And crucially, he only deploys 40% of his funds in this initial entry. It's his reconnaissance position, enough to capture a rebound, but not so much that he's overexposed if it keeps falling.
And his focus sectors are really specific, right?
Very specific. High volatility, but high certainty. He concentrates on cooling, servers, and energy storage.
Why those three?
Because they are the absolute non-negotiable infrastructure requirements for the AI boom. No matter how software gets monetized, AI models consume exponential power and generate massive heat. Cooling, servers, and energy storage are essential demand.
That makes perfect sense. It removes the software speculation risk and focuses on guaranteed hardware demand.
Then comes a patient move. He holds back the remaining 60% of his funds. He only deploys this patient capital much later, once the broad market has stopped falling and has settled into a mild dip or a range-bound phase.
So 40% chases the violent bounce, and 60% builds a foundation once the dust settles. It's a brilliant two-phased entry to manage risk.
And his exit strategy is just as structured. It's totally non-emotional. His target is rigid. He sells these AI stocks when they reach their previous high average price plus 20%. Once that number is hit, he triggers the exit.
And what does he do with the profits?
This is the genius of his cycle. He immediately transfers the profits, the initial capital, plus that 20% gain back into his broad index funds. This locks in the alpha, reduces his risk, and restores his portfolio balance ready for the next correction.
So what this all means for you, the listener, is that he isn't just rushing in. He's waiting for peak pain, using confirmation, and buying the essential infrastructure he knows has to grow. It's just a textbook example of how to execute a brave move. So what does this all mean? I think the takeaway is that buying the big red candle is never about guesswork. It is absolutely about understanding the context of the drop, patiently waiting for confirmation that the sellers are exhausted, and having the strict discipline to follow your plan.
Right. Don't panic, but don't be reckless either.
Exactly.
We've covered a massive amount of ground today, from the Fed's confusion to consumer health, the logistics crunch, and even the impact of geopolitical risks like those potential mineral restrictions. Our mission is always to give you the objective facts so you can form your own independent, critical thinking.
We never endorse any specific view. We just dissect the global discussion.
That's right.
And that objectivity is key.
Mm-hmm.
You know, we've seen the struggles of recent college graduates in this new AI-driven job market, but we also know the next generation is growing up as true AI natives. So here is a final provocative thought for you to sip on. If AI really delivers the massive productivity boom that the bulls predict, what's the real investment bottleneck can be 5 years from now? Will it still be hardware and GPUs? Will it be the colossal amount of power needed to run it all? Or will the real scarcity be human talent, the skilled people who can actually wield these new tools effectively?
That is something to think about. Thank you so much for joining us for today's deep dive on Sip and Talk. We hope this helps you find your own perspective in this volatile market.
And remember to subscribe to the Sip and Talk podcast. And for some fun, memes, and to see his latest travel vlogs, don't forget to check out our old friend Mickey's YouTube channel, Mickeytolife. We'll catch you next time.